We will now move into an area of finance that most Americans don't learn about in school: stocks, bonds, and commodities. I have been deeply involved professional in this area for many years with Steve. So listen as he strives to bring clarity to this vital area of investing.
With this session, we're moving into the world of investing. In prior sessions, we've talked about the need you have to build retained earnings, the need you have to budget your money so that you have retained earnings, and the importance of selecting the vehicle you use to invest, be it taxable or non-taxable. But this topic now continues as we discuss the specifics of what your investment options are. They're plentiful, they're sometimes complicated, and they're always important. The first thing to consider investing in is cash. That's right, good old-fashioned cash. This can be in the form of a savings account, a money market, or even actual hard currency. The good news about currency is that they're very liquid, meaning you can spend them readily. The bad news is, if there's inflation, they immediately lose value. But wait, everything is a good and bad, right? Yes, cash does too. In deflation, cash becomes more valuable. So as you look at your retained earnings, consider cash as a starting place to invest. Let's move on by looking at stock. These are such basic things, but so very important to you and me as we consider the foundations of investing. We talked in earlier sessions about this, but let me just restate it. Okay, you and I have a great idea for a new business. Let's say we're going to make widgets. Okay, we have a better concept for a design that will improve people's lives everywhere. We've done our homework and we know this is going to change the world of widget users. Okay, so we have this idea, but we have a problem. We don't have the money to build the factory or do the marketing or anything else. But darn it, we've got a great idea. We believe this company needs $10 million to launch it. But if we can launch it, we think it will generate $100 million in revenues with a 10% net income or $10 million in net profit every year. So how do we get things going? First, we establish a corporation. By statute and by common law, a corporation is a separate and distinct entity from its owners. The ownership of it is designated by shares of stock. So for our company, we're going to capitalize it, yes, that's a big word, with 100 million shares of stock. Now keep in mind, these shares have no value. They're just pieces of paper. Our goal through the business is to create value for them. In order to create our company and thus value for our shares, we need to raise the initial capital we talked about to get it going. So I'll assume for the moment that we're beyond truly new entrepreneurs who need what are called angel investors, and we can contract with an investment bank who, as we studied earlier, is in the business of finding capital for companies. We sit down with these investment bankers and agree. If the company does achieve its goal of $100 million in revenues and a 10% profit each year, that company could then be worth something like $150 million in the open market. Well, this is because we've looked at other widget companies and their stock tends to trade at 15 times net annual earnings. So we negotiate with our investment banker and settle on them putting an initial value on the company of, say, $30 million. Now, you may ask, why are we undervaluing this? Well, let's remember that the theoretical value of $150 million only happens if we hit our sales targets, right? So we have a discount on that value for the risk being taken that we won't achieve those goals at all. So we have 100 million shares authorized as we started the company, and we have a value, we believe, of 30 million in the marketplace. That translates to each share being worth 30 cents. 30 cents times 100 million shares is $30 million. Are you with me so far? This really isn't all that tough. Now, as we need to raise $10 million, we agree to sell 33 million shares for $10 million. That's 1/3, and again, you can get the math. Now, investment bankers don't work for free, so they take a fee from our $10 million. In this case, let's assume they charge 5% for the job. So to raise the $10 million, they'll get $1.5 million. So net proceeds to the company from this public offering is $8.5 million. So now if our investment banker is successful, they will sell 33 million shares to the public or to institutions, and we, as the company founders, will still own 66 million shares or a majority of the stock. Now, I apologize if I hadn't talked about it earlier, but when we establish a corporation, we need, as shareholders, to elect what's known as a board of directors. That board of directors runs the company on our behalf, and they will hire the executives, monitor the progress toward objectives, and make sure all is right with the world. These directors are elected by votes of the shareholders, so that shareholder that owns 51% of the stock owns the board of directors. So going back to our example, our investment banker is successful, and we conduct our initial public offering and sell our 33 million shares to various people and institutions. The stock is offered to and bought by these people at 30 cents. Now the stock is trading and entered what's called the secondary market, where these initial shareholders can sell their ownership in our widget company to others who might want to own it worse than they want to own it. Let's assume after raising our capital and now operating for a year, it looks likely that we'll achieve our business goals. Well, the stock will likely go up from 30 cents to a figure more in line with our new value, perhaps as high as $1.50 a share. This value, remember, is set on our belief that the company could trade at 15 times net earnings, and now, after a year of operations, we're on target to hit our earnings number. So the market understands this and would now price our stock accordingly. This $1.50 price represents a 500% return for the initial investors who bought at 30 cents. So if you put up $1 million, you got back $5 million. My friends, in a nutshell, that is how and why capitalism works. The entrepreneur had a good idea. The people and institutions are willing to risk their money on the idea because if they're correct, they significantly multiply their capital. In a socialist system, it's the government who decides which entrepreneurial ventures will be successful or not. Now, this session isn't about that, so let's move forward. Oh, there's one more concept we should bring up. Prior to the public offering, you are considered a private company. That's right. The only difference between a public company and a private company is that the public company has its ownership or stock traded in the public markets. Public company stocks are far more liquid than private company stocks, which is why more people buy them. Today, there are thousands of public companies that would welcome you as a shareholder. Some are very good investments in that the business model and the management are aligned to increase value. Some aren't. Let's look at companies like General Motors or Chrysler. Oops, they went bust. When you buy a stock from your broker, you're buying shares in a company no differently than our example. When you buy a share in Apple, Microsoft, IBM, or General Electric, you're buying their stock in the secondary market with the belief that that stock's value will rise because they will either meet or exceed expectations of their overall business plan. This is such a simple concept, but it's lost on so many. Going back to an earlier example I gave of someone who once said to me they buy mutual funds because, I'm quoting, they always go up. Well, the mutual fund, that is an equity or stock mutual fund, has a manager whose job it is to buy and sell stock in companies that will do better than other companies. In future sessions, I'll explain how they make those determinations. So that's all you truly need to know about stock per se. It's an equity investment, meaning you bought ownership in the company, as opposed to a debt investment where you loan money to the company. Let's further remember that on average, over the last 100 years, stocks have had an aggregate average return of about 8.5% versus inflation, which has averaged around 4%. Well, let's move into the world of debt. Okay, so you've worked hard, you've been disciplined, and now you have retained earnings. But you're building your portfolio of wealth, and you decide that you're more comfortable loaning someone money than buying ownership in something. There's logic to that. Buying ownership in something can be more volatile than loaning that money. Further, when you loan someone money, it's customary to receive interest. Now, ownership in shares in company typically don't spin off interest, but they spin off something referred to as a dividend. So if you need income, you should either loan someone or some company money and receive interest, or you should buy into a company whose board of directors has voted to pay a dividend. Now, by the way, going back to our taxable situations, a dividend is considered a return of capital. So it's not deductible to the company, but it is taxable to you. That's why many shareholders complain of this as double taxation. So we've decided to loan money to receive interest. We can loan our money to people, companies, cities, counties, states, or even the federal government. The big distinction here is how much risk you want to take. And do you need tax-free interest or taxable interest? We mentioned in earlier sessions that local government loans typically are free of federal taxation for purchasers who live in the state of the issuer, and federal government loans are free of state taxes. This can be a big deal, especially in high-tax states like California, where your total tax in the highest brackets can exceed 50%. So which is more valuable? A 6% bond from General Electric or a 4% bond from the state of California, assuming that you live in California? If you do the quick math, 4% divided by a 50% tax rate is equivalent to an 8% pre-tax return. So purely on the economics, the California state bond would return more to you than the 6% General Electric bond. The second dimension is risk. Now, risk on a bond has a couple of different faces. The first risk is that you don't get paid back. This is known as principal risk. You loan $100 to your brother-in-law, and you can probably just write it off. You loan $100,000 to your bank via the purchase of a CD, and you'll likely get paid back. Each category of bonds has a slightly different risk profile. The most secure bonds offered are by the United States government. Why? Simple. The federal government has the power to tax, and thus it's the most likely to survive in a really bad time. Government is the last one out the door, so to speak. Second to that are either big company bonds like General Electric and Procter & Gamble, or some states like Texas and Florida. I want to caution investors who like the tax-free nature of state bonds and think they're safe because they're offered by states. Well, friends, states can and have defaulted on bonds before. The state of Illinois, where I live, it's broke, period. The state has publicly said it won't be paying vendor bills in the next fiscal year. If this is true, bond interest can't be far behind. On the business side, the poster child for bad bond investments is General Motors. So part of bond investing is understanding the principal risk that you face. The second risk is interest rate risk. And here's a quick lesson on that. You loan your money to a company today, and in return, they agree to pay you 5% interest. Remember, we're in a low interest rate environment. Okay, so you get your payments, and let's say you want to sell that bond and get your capital back in 5 years. At that time, though, interest on competitive bonds is paying 10% because we're experiencing inflation. Okay, so you go to the secondary market, we've discussed that, and try to sell your bond. But investors now say they'll pay you only 50% of its value. Why? Because to get a competitive interest rate on your bond, they have to pay less than the face value. This time risk, to put it another way, is very real. Remember, the longer you tie up your money, the more you put at risk. Okay, so we've now thought about stocks, which are equity, bonds that are debt. What other choices do we have with our hard-earned after-tax retained earnings? Another viable choice is commodities. Sounds fancy, doesn't it? It conjures up images of farms and corn crops. Well, it's more than that. A commodity is a hard asset, including gold, silver, crops, currencies, and other things like paper. Many of these have active markets and trade very regularly. In fact, you and I can read regularly about gold these days. Well, the truth about commodities is they tend to trade and change in value in line with inflation. In reality, no more and no less. So to that end, they're great inflation hedges, but not really all that good to beat inflation. Now, with that statement, some of you are going to say, wow, but you keep recommending gold. Well, that's true. Gold is a very liquid commodity with a lot of trading vehicles and relatively low transaction cost. And add to that I do believe we're headed for a round of inflation. Yes, I've been recommending gold for quite some time. Now, what else? Okay, there's certainly real estate to be considered. Rental properties, as we've discussed, have very nice tax advantages. Real estate isn't as liquid as a stock or even a bond. And generally, many real estates aren't quite as passive as owning stocks, bonds, or commodities. You actually have to work. You work to find renters, you work to improve the property and all that. But at the end of the day, you may walk away with more than a 10% tax-preferred investment. Oh, but don't forget this too. You have principal risk in real estate. Your property can go down in value. Well, continuing, there's always collectibles. You can buy artwork, jewelry, or even memorabilia. Remember from earlier sessions, an investment is anything you buy that you intend to convert back to cash and that you can reasonably expect to increase in value. Some memorabilia has proven to be highly successful as an investment. Oh yeah, there's a typical problem though. Would you be able to know which ones work before they've worked? That's a harder question. Okay, in another session, we'll look at how these things are packaged together. But that's a quick list of different investment ideas. And oh, you may not know this, but you just got introduced to the fancy concept of asset classes. Now, it's beyond the scope of this session to fully explain asset allocation, but I'm going to go there for a bit. Now that you understand asset classes, asset allocation is simply a process of deciding which assets you want to invest in and in what proportion. Let me make a quick observation of one of the crucial mistakes people make when managing their retained earnings. They look at their investments in separate pots. For example, they look one way at their 401k, another way at their IRA, another way at their savings, and another way at their house. Well, as you are one person, one family, you have one pool of retained earnings, not several. So these things all need to be thought of together when you decide where to invest your money. For example, you may already have a hefty allocation to real estate. Maybe even you're getting some rent from it. If you're paying down your mortgage each month, you're doing that, right? So you're getting some increase in value in your real estate. And don't forget to consider that. That's an investment. Yes, you benefit from your home, but just because of that, don't go out into your other investment monies and allocate more money to real estate just because you don't think you already have a real estate investment. You do. Now, asset allocation is typically thought of as a way to attempt to maximize return and minimize risk. So a number of fancy formulas exist to maximize that risk-return relationship and the correlations of returns among these asset classes. In general, these different asset classes are uncorrelated. Now that's a fancy word, but it means this. If one goes up, the other goes down. If interest rates go up, bonds go down, but commodities likely will go up. There are so many ways to segment these things that I think sometimes they get overcomplicated. People will classify stocks, for example, as large cap, mid cap, or small cap, and micro cap. But they also slice and dice it up into growth, value, momentum, GARP, which is growth at a reasonable price, and even by industry, sector, and market served. I mean, you can spend years building sophisticated computer models to measure and weigh every alternative you have. And to some extent, sophisticated asset allocation does work. Okay, I buy that. But And get this, in 1997, we had the poster child for the failure of genius, long-term capital. These Nobel laureates built a computer model that did all the fancy mathematics in the world and came up with an asset allocation model that was perfect, at least in their mind. Their model never failed, according to them, and generated a perfectly smooth return pattern because these geniuses had figured out how to perfectly play these correlations against each other. When this asset went up, this one went down. When this one went down, that one went up, and so on and so forth. This was so perfect, they put some leverage on it to increase returns. Let's say, for example, that you're so smart, you built an asset allocation model that generates a perfectly smooth 2% annual return. Well, 2% is not so great, right? And we've talked about expectations, and we could do that in a treasury bill. Well, if we're perfectly stable, though, you can borrow money to leverage it up. A 2-to-1 leverage means that for every dollar you invest, you can put up another dollar. That's the maximum leverage that you, as a normal investor, are allowed to use. So at that leverage rate, 2-to-1, you don't earn 2%, but 4% minus the cost of borrowing. So let's say you get 3.5%. Now that's not bad. It's more like a normal bond return. Well, let's remember, we're Nobel Prize winners and we're geniuses and we never fail. So let's lever it up 30-to-1. How's that? So now, based on that 30-to-1 leverage, we estimate a 60% annual return. And since we're Nobel laureates, we'll raise $1 billion in capital and borrow $30 billion from the investment bankers on Wall Street. So now we'll have $31 billion in investments. That sounds great, doesn't it? But what if we're wrong? What if one of our investment models doesn't work as planned? Now, here in our world, that's yours and mine, has anything ever gone wrong? Has a computer failed when you needed it most? Or a tire gotten a hole in it when you were headed to somewhere very important? In our world, the real world, sometimes things do go wrong. Well, guess what? It did go wrong for our Nobel Prize winners too. A model that estimated returns within their asset allocation model, a model that estimated returns from Russian bonds went awry, and long-term capital lost a great deal of money. In fact, so much that in 1997, it almost brought down the U.S. economy. After a bailout orchestrated by the Federal Reserve, the major Wall Street investment banks stepped up and bought the assets of long-term capital. In further sessions, we're going to look how investments are valued and how erroneous conclusions can be made.
You have learned more in this part of our investing section than probably 90% of high school and college students. Steve has provided a solid basis for understanding to once again give you help in your planning of your financial path. Steve will now introduce some ideas that are new to many of you, but equally important in your full understanding of investing. Now let's hear about packaged products, ETFs, and other derivatives.
We have now introduced to you the basics of understanding investments, stocks, bonds, cash, commodities, real estate, collectibles, and even insurance products like whole and universal life and annuities. But there's more to demystifying Wall Street. As investment professionals grew through the 20th century, they worked diligently to create new financial products that derived their value from these basic asset classes. The chief among these was the mutual fund. Created by the Investment Company Act of 1940, mutual funds represented a terrific way to allow retail investors to broadly diversify their holdings without incurring the cost or complication of building large portfolios. The best example of this is the well-known Fidelity Magellan Fund run by the famous Peter Lynch. At its peak, Fidelity Magellan held over 1,000 stocks in its portfolio. Now recall our prior sessions where we talked about the widget company that went public and now traded its stock in the secondary market? Peter Lynch's portfolio held over 1,000 of these. Now, that's certainly materially easier than you going out and trying to determine the best widget companies to own, and then going out to build a portfolio and monitoring them for substantive changes. Today, there are mutual funds that are created to invest in virtually every asset class and every investment style. You can buy large company stock funds, small company stock funds, government bond funds, corporate bond funds, commodity funds, real estate funds, and just about everything else. If it can be bought and sold, Wall Street has created a mutual fund to package it up and sell it to you. At the core, a mutual fund is a pre-built portfolio, right? So the value proposition that's being sold to you is that you should pay someone else to build these portfolios for you. There are two basic underpinnings to this argument. First, the third party can do it cheaper. Okay, is it cheaper for the Vanguard company to go out and buy the S&P 500 group of stocks, then package it up as an open-ended investment company or mutual fund and sell it to you? Or is it just cheaper for you to go out and buy 500 individual stocks yourself? Certainly in the pre-personal computer days, it was cheaper and incredibly more feasible to have someone else do it for you. Now, though, the cost is probably a push. Between the record keeping you would incur by owning 500 individual stocks and the money you'd spend making sure to rebalance this portfolio, and by the way, to rebalance means to set the volume of the stocks you own to a predefined level. For example, let's assume you want equal weighting so that you want to own the same dollar amount of each stock. Well, if you have 10 stocks as an example and you purchase $1,000 of each, well, what happens if one stock's share price rises and another falls? You no longer have an equally weighted portfolio. Stock A may be worth more than stock B and so on. So one of the values that a mutual fund company provides is to monitor these positions and buy and sell to keep your portfolio in balance with its objectives. My bet is that it is in fact cheaper to buy a mutual fund than invest directly yourself. Thus, we then approach the second question. Can the mutual fund investment managers outperform you? Well, here, folks, I say the answer is yes and no. Some managers do outperform their stated benchmarks, others do not. In the sessions on expectations, I mentioned that the average stock return over the past 100 years or so has been around 8.5%. Well, the question is, if you pay a mutual fund to manage your money, would they have done better than 8.5% net of all fees? According to a recent study by the University of Pennsylvania, because the best managers have been recruited to other areas of finance, hedge funds specifically, and the markets have become more efficient with the increase in technology, get this, less than 1% of all funds really beat their index benchmarks. That's netting out all costs and fees. Wait a minute. That study from a well-respected university is saying that virtually no mutual fund really beats its index? So if we want to achieve market returns over the long term of 8.5%, that's suggesting it's not worth me paying anything to a manager who claims that he or she can improve on that. So in the world of mutual funds, I would recommend, and I'm sorry to say this to those in the business, but facts are facts, you'd frequently be better off just picking an index fund, or in other words, a fund that isn't actively trying to beat the market or its index, just match it. And here, simply look for the cheapest way to do it. Now, with all that said, there are some specialty mutual funds like some of the long-short funds. Okay, here we go, dispelling complexity. A long-short fund is one that buys some stocks because they believe they'll go up, and sells short other stocks because they believe they'll go down. It's not too difficult. In the ways of Wall Street, you can sell something you don't own by borrowing it from someone else. This borrowing and then selling the asset, hoping it will go down in price, is known as going short. So these managers who run long-short funds are buying stocks they believe will go up and selling short stocks they believe will go down. If they do this right, they negate the impact of the market's overall moves. Okay, now that sounds complicated, so let's try to simplify. If I own the Dow Jones 30 index of stocks, so say 30 stocks, and I then go out and borrow the 30 stocks from someone else and I sell them short, I have effectively guaranteed a zero rate of return. If the Dow stocks move up, I make money on the positions I own or the long positions, but I lose money on the positions I sold short. If the opposite happens and the Dow moves down, I lose money on the stocks I own, but I make money on the stocks I had sold short. There's some slippage in that transaction due to transaction cost, but for illustrative purposes, let's just say you make zero either way. Well, some of these managers believe they can predict not the market per se, but different stock returns. For example, in the last couple of years prior to the bankruptcy of General Motors, a great long-short trade would have been to buy Ford Motor Company and sell short General Motors. Because they both move with the market, regardless if the market goes up or down, these stocks will move with it. But because Ford's business model was more stable, it was likely that if the market went up, Ford would move up more than General Motors. And if the market moved down, Ford would go down less than General Motors. This is what's known in the industry as a pairs trade, because you're pairing two stocks together. Instead of earning market returns, which have been taken out because you're long short, you earn the relative difference in return from these two stocks. In a rising market, if Ford goes up 2% and General Motors goes up 1%, you earned 1%. In a declining market, if Ford goes down 1% and General Motors goes down 2%, you still earned 1%. You only lose money if your stock selection inverts. In other words, General Motors does better than Ford. Well, because of this hedging, there's a dynamic in that some mutual funds generate returns that are not really correlated to the market at all. They can go up or down and still make money. Schwab offers something called the Schwab Hedged Equity Fund, which is one of these long-short funds. I'm a little biased on this, of course, because Charles Schwab bought my company in 2000, but I find the Schwab Hedged Equity Fund to be a very solid play in the world of long-short investing. Anyway, with the thousands of mutual funds that exist, I will say this as a conclusion to this session. If you don't want to hire an overall advisor to build your portfolio, and you really don't want to spend a lot of time thinking about which funds to buy, just buy an index. If you, as your own CFO, want to have some exposure to the stock market, an index fund is a cheap and efficient way to get you there. Now, we're talking about reducing cost when we don't think we can receive value over and above the market. That is to say, when we think we're just trying to meet the market return, not beat it, we should focus on cost. A new way to do that evolved over the past decade is known as the Exchange Traded Fund, or ETF. Okay, this really isn't all that complicated, so let's try to learn what they are. When you buy shares in a mutual fund, there are certain characteristics you get in return. One, the pricing of your shares is done only at the end of the day. So that's when you can trade them, once per day at the end of the day. Further, because you're buying a portion, now albeit a very small portion, of the mutual fund's ownership, you will incur tax consequences as the fund buys or sells stocks. That's why there's an old rule to never buy into a mutual fund in December. The reason is that even though you haven't owned the fund through the year, you will be allocated your share of its gains and losses directly. So even though you've earned nothing, you will receive a paper gain on which you pay taxes. The ETF model changes this a little. The ETF is actually bought and sold like a share of stock. So in the case of the index ETF, like the Dow 30 ETF, the ETF company would purchase the 30 Dow stocks and manage them within the ETF. Now, here are two big differences. First, with an ETF, you're not buying ownership rights as you are in the mutual fund. Therefore, ETFs trade in the secondary market, we've discussed that, as a stock that's bought or sold. So you don't have to wait till the end of the day to buy it or sell it. You can sell it anytime during market hours. The second major difference is that you can better manage your capital gains and losses. Because it's traded like a stock, there is no distribution problem at year's end. If you don't want capital gains, just don't sell the ETF. On the contrary, if you have gains in other areas and want to offset them with losses, you can sell the ETFs that have lost money. Like mutual funds, there are ETFs to buy and sell virtually every asset class you want. If you want to buy gold, there's a gold ETF. If you want to buy international stocks, there are global ETFs. The good thing about ETFs is that they're cheap, and you can manage them for taxes slightly better than you can mutual funds. And finally, they trade during the day, not just at day's end. Why then doesn't everybody just buy an ETF? Well, as of 2010, most ETFs are passively managed, meaning that they don't employ active management to attempt to beat a given index. This is changing, but it's still generally a true rule. So if you're out to find a manager to beat their index, you're going to have to go to the mutual fund world, not the ETF world. So ETFs have brought a needed competitor into a space against mutual funds and have served to continue to reduce cost. Again, beating an old dead horse, when left to its own devices, the free market will develop solutions to virtually every need. The next investment vehicle I want to explore with you is the Unit Investment Trust. I mentioned these in earlier sessions, and I think as part of your investment strategy, you should definitely consider them. Unit investment trusts, at their core, offer you a highly disciplined, no-maintenance way of accruing investment returns. These are typically 13-month vehicles, so they're long-term capital gains preferred tax rates, and they're offered in a wide range of investment styles and asset classes, and they're relatively inexpensive. So here's how they work. Each month, the Unit Investment Trust Company, for example, in my hometown of Wheaton, that might be First Trust Portfolios, they offer a variety of trusts for sale. Some are equity trusts that serve to meet an index return like the Standard & Poor's 500 or the Dow Jones Industrial Average. Others use more complicated computer models to build their portfolios, and they are designed to beat their index. Others are fixed income and designed not necessarily to produce monthly income, but they're designed to accrue their interest income and thus increase the value of the trust over the 13-month holding period. This is actually a nice way to earn interest income without it being taxed as interest income but capital gains. The really nice thing about UITs, as they're known, is that they're simple and usually on autopilot. Without any effort, they just roll over each 13 months, so you can just passively participate in the growth of the markets that you believe will go up. Switching gears a little bit, I want to introduce the notion of options and futures really quick. Now, we all hear about derivatives and how dangerous these things are and how they cause systemic risk. Well, nonsense. Properly managed, derivatives like options and futures can add return and protect returns from being reduced in value. Farmers, for example, for generations have used the futures markets to protect their crop values by locking in future relative values. Here's the basic idea. In a free market, some people think an asset is worth more than other people think it's worth. That's the underlying magic and risk of the free market. Someone is right, the other person is wrong. Okay, so an option works basically like this. You believe something is going to be worth more tomorrow than it is today, but you don't want to commit enough money to buy the whole thing. Okay, let's assume you see a house and you like it and it's $250,000. You have a job promotion that's likely coming down the pike, so you'll need to move into the new city and you liked this house. Well, you don't want to commit to buying it because your promotion might not come through, right? But if your promotion comes through, you want to buy it. Now, on the other side of this story is the owner of the house. He's got to sell it because he lost his job. Now, he can sell it today for $220,000, but he'd much rather get the $250,000. He determines that if he waits 90 days while you find out about your job, he'd be okay. If your job doesn't come through, he'll sell it for $220,000. But if it does come through, he can get $250,000 from you. So he agrees to sell you an option to buy the house for $240,000 in 90 days for $10,000. So what a deal. Instead of you risking the whole $250,000, you now have an option to buy the house if your situation works out, and you can buy that option for only $10,000. In this scenario, the owner of the house wins. If you don't follow through, he keeps the $10,000 and sells the house for $220,000 for a total of $230,000. If you do follow through, he gets $240,000 plus the $10,000 or $250,000. For you, if you get the promotion, you pay $240,000 for the house plus the $10,000 or the $250,000 that you had agreed to. But if you don't get the promotion, you're only out $10,000, which is nothing compared to what you might have lost if you had to buy the house and then resell it. That's a basic what's known as call option strategy. You buy the right to call away from the owner their asset at a predetermined price for a predetermined time frame. The owner of the house sold the call option and in doing so generated immediate income, with the only risk being that if the option was exercised, he'd have to sell the asset at the appreciated price. In the world of stocks, if you own a stock, you can sell a call option against it to someone just like our homeowner did. If you own a stock at, say, $17, and you really don't mind selling it if it gets close to $20, I assure you there's someone out there who wants to buy it at $20, but doesn't want to pay the full amount. So you sell them a call option to buy that stock from you at $19 for $1. Now here's the math. You immediately get $1 in income. That's a 5.8% return, by the way, not bad when you consider the returns you get at the bank. Well, anyway, if the stock goes to 19, your call buyer will call the stock away from you and pay you $19, and voila, you have your $20. $19 he paid you plus $1 in premium. Now, if the stock doesn't move up to 19, you keep the $1. Sound fair? You bet. This is known as selling a covered call, and it's a great way to earn income from the stocks you already own. There are a host of option strategies that you can invest in, and that's beyond the scope of this financial literacy program. But if you'd like to learn more, you can explore our private offering, the Buttonwood Club, which is made available for members of the Steve Beeman Group who have been certified as having passed our financial literacy program. As we move on in our course, we'll look at that critical next step of how you determine something's value. After all, knowing your options for investing is one thing. Knowing which thing to invest in is quite another.
It is unlikely you will hear ideas, content, and solutions like this in most other financial programs, unless you are an investment professional. Let's continue on the journey of investing outside of the United States.